Hello there, everyone, and welcome to this edition of the podcast, where we are joined by what's your name again? By Ralph, who's got a spider on him at the moment. The spider's very well behaved. It's sitting on his chest. But don't worry, anyone, it's stationary. So anyway, yeah, let's talk today about there's two things. So one, let's talk about bubbles. Right, and I'm not talking about Michael Jackson's ex monkey. So bubbles, and we're going to talk about, and I mean a monkey. That's not a euphemism for anything else. And also we could talk about the London market, the demise of the London market, which is particularly bizarre because both of us used to work. We met each other. Our eyes met across a crowded dealing floor. At a company which was very famous for doing massive deals all the time, right? So anyway, right, let's talk about bubbles. Let's talk about bubbles, darling. Everybody does. For anyone who's ever watched Little Britain. So there's been some bubbles here. So everyone's talking about it. So gold, Bitcoin, AI. I mean, even the Bank of England has got involved in, has got involved in saying that there's a big risk of an AI bubble bursting. So anyway, let's talk about those, or let's talk about gold, Bitcoin, and AI. I mean, gold has. I really want to burst into that song, gold, but I won't. So gold has burst through $4,000 per troy ounce, which is amazing. It's up like about 50% so far this year alone, which is incredible. And it's a safe haven asset. Central banks have been buying it. Just nervous investors have been buying it or buying into it, which is another reason why they've had some IPOs of gold related companies doing really well, because that's another way into it as well. So gold continues to go up, and with all the uncertainty and stuff that we see in the world at the moment, both politically and economically, it seems to be the sensible place to park your money. So, what do you think, Ralph, about the gold bubble at the moment?
Yes. Excuse me, guys. Indeed, we've talked about gold before on this show, I remember. And when we did, I had just read a research paper on the status of safe haven assets, which featured on gold and also on Bitcoin.
Mm-hmm.
And well, so yeah, that's the sort of thing I get up to. Other people may read a comic book or something interesting. I read research reports.
Of course you do.
Everybody, it's like drum roll,
Yeah,
boom,
yeah,
boom, boom.
yeah.
By now, everybody has switched off because this is clearly weird. Anyway, excuse me. Again, what I read in that report is that the authors had established that indeed, clearly, no prizes for guessing that part, that indeed gold has been seen as a safe haven asset for a very long time. Indeed, the driver for an appreciation in the value of gold is typically that there is a perception of increased risk in the marketplace.
Mm-hmm.
What type of risk is unclear, could be anything, but recently, of course, it has been geopolitical risk.
Mm-hmm.
In particular. And the authors were correlating this using weird and wonderful statistical methods with the price of Bitcoin, and concluded that Bitcoin has also, of late, exceeded that status of safe haven currency, safe haven asset. And this is sort of interesting to me because we almost like now have an alternative to gold if we are looking for a place as a store of value, while we are getting worried about the performance, the return performance of the more traditional assets, which of course is bond markets, the equity markets, and for those who are brave enough, the currency markets. So I have got a chart here actually everybody has this chart here because it's on the internet, but I found it. And it's basically just the gold price in pounds for an ounce of gold since the dawn of time. And in 1970, it was 15 quid. So you could buy an ounce of gold for 15 quid in the 70s. That was the time of weird ties and odd cars, which of course nobody remembers because your audience is exceedingly hip and young. But I do because I don't want to talk about it anyway. So in the 70s, it set you back 15 quid. Now it would cost you 3,000 and something, 2,600 pounds. What you guys may have in your mind is that it's the price of like almost $4,000. That's dollars. I'm looking at this in pounds here. So now it is 2,600 pounds. So clearly that's more than 15 quid. So it has gone up. Great. Now, putting a little bit more mathematics behind this, if you actually look at this over this period of time, which is about 55 years, and calculate the annual return, then you get to something like 11%. So an 11% return per annum for holding an asset is actually really very good. Let's not pretend that's nothing. But it is not a stellar type of return, a gargantuan return, which you received had you held Bitcoin from its inception to now, which is 1.9 times per year. So it almost doubled every year had you done this. So that's the observation number one. And then the observation number two is, of course, well, I say of course, but it is more pertinent. Clearly, this 11%, which I calculated, is a mathematical fact, but you wouldn't have got 11% every year. There are vast periods of time here during which you would have held gold for no return at all. And so I'm just looking at this roughly. I'll do this roughly. Had you bought some gold in 1980, in the 80s, let's say, it would have set you back something like 250, 270. Let's call it $300. And then in 2006, the price was still $300. So during that period of time, which is sort of 27, near 30 years, if you had just held that gold, why do I say gold? I am German, but this is English, so gold, people. I'm talking about gold here.
Yeah.
I need to work on my accent. It's very embarrassing.
Nice. Sorry.
So you would have held gold for no return. Nobody would have paid you for holding it. And what that highlights is nothing more than the fact that gold is a trading asset.
Yeah.
So it may be a store of value. This is true. During this entire time, gold has there were periods where the price of gold depreciated. That is true, but it never depreciated by all that much. So it is a store of value. If you put your money there, you can be sort of reasonably certain that the value of your money is not going to degrade by all that much if you hold it for long enough. But it does not follow that you are going to make a bonanza return necessarily. And of course, we need to remember what gold is. Gold is a yellow, shining metal that has no use in industry or anywhere else, which is merely demanded because it looks nice. There is demand because it's jewelry. It is a circuitous thing. There is demand for it because people want it. And I know this is a tautology, but I still phrase it deliberately like this because there is no intrinsic value in gold. It doesn't pay you a dividend. It's not like a share in a company where you get dividends, where the company produces earnings. This is simply a chunk of metal on your desk, maybe, if you want to keep it there. And therefore, for it to even be a store of value, there has to be sustainable demand for it. For it to be an asset which you would seek out at times of uncertainty, there has to be demand for it. And it is precisely this type of demand which I was articulating that drives the status of gold as a store of value. It is simply the psychology that gold is a store of value. It is again completely circuitous, but it works. And it has always worked. It is not the only store of value. Of course, diamonds have worked for a while, but there's a danger because now we can lab grown them and the price has corrected downwards quite materially. Silver is a store of value, but gold is is the gold standard for obvious reasons. Now, let me therefore now say, so during the period of time which I mentioned, you would have held it for nothing and you would have not been very happy. But then we go into the foothills of the outperformance here in the chart. And from 2007, where it was a 300 quid or so, to 2012, 5 years, it would have grown to £1,000 per ounce. So
Yeah,
this is
that
now
sounds about
more
right, yeah.
3 to 4 times appreciation. So that's good. Then it did go into one of the rare periods of time during which it lost value. But I'm going to cut to the punchline here. Very recently, I'm starting the clock here in 21, it was £1,300, and 4 years later, which is now, it's trading currently at £3,000. And so therefore, we have a very material return in a very short period of time.
Yeah.
What drives this appreciation in value in an asset that does not pay you dividends and that has no intrinsic value in it whatsoever? It is the perception of uncertainty. And that, of course, we all know. You don't need me to give you the bullet point list. Nevertheless, since 21, we have been in crisis after crisis. I mean, ever since I'm unfortunately very old, and so my memory does go back a little bit of time, certainly to the 70s here. And in my living memory, we've not seen a period of time during which the crises or development perceived as crises was so dense. Dense is the word. I mean, if you just remember, we had Brexit followed by COVID, followed by these all blend into each other, followed by Ukraine, followed by Trump. And these are 4 crises. It's not as if we had one crisis, then nothing, then another crisis.
No,
They
you're right.
just blended into one another. So it's been since Cameron sort of called out the British population and lost, and we had Brexit. Since then, we've been in a permanent sort of crisis of different natures, but it was permanent.
Yeah.
The only other time, I mean, I'm not saying that previous to that we didn't have crisis. I mean, in the 80s we had the dissolution of the Soviet Union, but that was also seen by many as an opportunity. So these crises all generated some other unpleasant stuff. We have hyperinflation, or maybe hyperinflation is not quite the right technical term, but very material inflation with all the negative impacts of that. Your household income is shrinking because the mortgage cost is rising, etc. We've all lived through it. We know the story. And clearly, at times like this, I'm not saying you cannot make money in the equity markets in trading through crises. But what I am saying is that it does take a person with the time and acumen to keep their eye on the ball if they want to make money in the equity markets during these types of crises. Much easier to put your money into an asset seen as a safe haven and benefit from the sustainable outperformance at time of sustainable crisis. And that has happened in gold. And this is where I kind of stopped then for my thoughts, referencing again that research paper I read that has also driven, as far as I can see, anything to be a driver of blockchain and associated cryptocurrencies. That has also been the driver of cryptocurrencies, which are now also seen increasingly as a safe haven asset. Unlike gold, however, that's just what I wanted to point out. I believe the safe haven status of cryptocurrencies has one aspect to it which gold can never have. And that is that cryptocurrencies are not regulated by the institutions of nation states, which will be seen by many as an advantage. Those people, those investors who may perceive the geopolitical risk of such intense nature that they may sort of convince themselves that the integrity of the nation state itself is at risk. And what would we have? For example, now I'm going to be deliberately, what's the word, hyperbolic here. What if in the United States, for example, we did have what fringe communities in that country have been cautious or anxious about for a very long time, meaning civil war? What happened if Trump's deployment of national guards changed into the deployment of the military on the basis of an invocation of the Insurrection Act, which he has recently elucidated he might do. He has done this before. This is not alarmist. Nevertheless, he's done this before. His speech to the generals in Quantico mentioned the words invasion, enemy from within. These are words which are quoted verbatim in the Militia Act of 1700 and something, the extension of which is the Insurrection Act. His playbook is to invoke manufactured crises on the basis of which he can then sign executive orders to bypass Congress. We have discussed it many times. This is AIPA and some other acts. So all these playbooks, they all blend into one. I'm not saying he will do this. What I am saying is that for those willing to look, and for those willing to see that as a risk, and for those willing to get scared by it, there is enough evidence there for somebody to put together into a scenario for the future that may well foresee a weakening of the nation state itself in the United States. And in such a scenario, where would be a safe haven for your money? Yes, it may still be gold, but it also would be an asset which perhaps is no longer regulated by the very institutions of a nation state, which would then, of course, be also compromised in such an event. And that is crypto. And so from that point of view, I'm not, don't get me wrong, guys, I'm not saying this will happen or this is even maybe a plausible risk. What I'm saying is that there will be people around who are thinking like that. And that is, I think, what is driving, what may be driving the support of the valuations of cryptocurrency as a safe haven asset, which have got this particular aspect to their properties, which gold doesn't have. So these are some thoughts.
Yeah, no, I agree, and I think I would also add something really basic as well, is that I think that many people will have, I mean, especially if you're feeling under pressure, financial pressure, you would have heard anyone, maybe acquaintances, friends, etc., who boasting about buying crypto and how well they've done. There may well be some pent up demand out there, and the thing is that pent up demand has been building because crypto's gone up. I mean, okay, it's come back recently, but it's still high. But yeah, I mean, the fact that look like there are going to be more ways of people to actually buy crypto means that and there is demand out there. So I mean, I think underlying that's also going to help as well. The more ways that people can actually get hold of crypto and ideally be able to trade it, then the demand's going to go up because the demand is there. They've already seen the asset go up so much, they want a part of it. So,
I
so I
agree.
think there's that. I think there's a bit of that as well.
Absolutely. It's the availability of it, ease of access, and that makes it much more as a commodity which you can hold. Indeed, I believe, I hope this is correct what I'm saying. Please fact check this. I think this has already been, no, this can't have already been done, but I think it is being mooted that you can now hold gold and crypto ETAs, and an ETA is an exchange traded ETFs, I'm sorry, is an exchange traded fund. Let's not go into the detail of what that is. I mean, it's basically just something which acts like a share, but is supported by a basket of assets. And the basket of assets which is supporting these particular ETFs I am referencing here is crypto. And so you have crypto and gold backed you had gold backed ETFs have existed for a very long time, but now you have got crypto backed ETFs that were admitted to the London Stock Exchange, I think 2 years ago, or maybe even as early as 1 year ago. So now they're tradable, and now what is going to happen is that you can hold them through your ISA. Which is absolutely astonishing. I mean, so this basically opens the gates for the normal investor to hold crypto through an ISA, which is, of course, as you guys know, this is a tax incentivized investment, which is basically part and parcel of normal people's savings plans.
I mean, this is interesting because I was saying this to my wife, who's a independent financial advisor to high net worth individuals, and she's often said, and in the past, that like everyone keeps asking, how can I get exposure to Bitcoin? How can I do this? How can I do that? And I think with this change in the law, this is this is a big thing. I mean, okay, probably first of all, it's going to be the people that are very affluent who are already kind of thinking in these ways are going to do it, but it will filter through to everyone else. Absolutely. So I think, very interesting. Anyway, got to move on. So next thing, just very quickly on AI. I mean, I think that even the Bank of England got involved in saying, "Oh, look, there's going to be an AI. There's such a risk of AI bubble." This is basically a bottom covering exercise. I think the thing is that if they don't say it and there is a burst, everyone's going to go, "Why didn't you foresee that? Why didn't you foresee that?" So that's why they're saying it. I mean, that's they're not going to say that, but that's what it is. All I would suggest on this, in the AI sphere, is that obviously lots of people have investors have powered companies involved in the epicenter of AI, like Nvidia and OpenAI, etc. They've powered their share prices up, hugely. I think that this, that's the obvious direct way in. However, I do think that the infrastructure is where, personally, I think it's the infrastructure is where it's at. And the reason why I think that is because I think that AI may well, the sentiment may change. I think, is there going to be another DeepSeek moment where everyone has a shock and thinks, oh, actually, the received wisdom of throwing more money at AI is the way to go. Therefore, we need to, invest here. There could be a DeepSeek moment where that all got thrown out of thrown into disarray. Or the other thing is that people might think, actually, do you know what? AI is useful, but it's not as broadly useful as we thought it was going to be. And therefore the demand is less, the example of that. I mean, we've talked about this recently about how there seems to be a perception where everyone says, yeah, AI, yeah, brilliant, absolutely brilliant. But it doesn't quite do what I want it to. But I'm sure it's great for everyone else. And the problem is a lot of people and industries are coming to this conclusion. And if that's the case, at some point, someone's going to go, actually, it's not the danger we thought it once was, we once thought it was. And so and so sentiment changes. But the reason why I say that the infrastructure is where it's at is because even if I believe that even if the sentiment towards AI changes, the demand for power is still going to be there, and it's because we need cheaper access to power to power our homes, but also it's going to be underwritten by the. I know it's boring, but the uptake of electric vehicles. I know that a lot of these companies have said, "Oh, we're going to push back the introduction of but they're still coming. They're still going to develop them, and they're still coming to market. So, let's say roughly the take up at the moment is roughly 5%. 5% is nothing. So there's a huge demand. So even if, my argument is, even if sentiment in AI gets worse, that slack is going to be more than taken up by the demand for electric vehicles. So
this is actually very interesting. Your point. I would just a few bullet points from me. The first one is it a bubble? Yes, perhaps. Yes, absolutely. You heard me say this several months ago, or whenever it was, when we were talking about the valuation of OpenAI. Oh, by the way, quick one. I would say perhaps if you're interested in this and to which extent it is a bubble, to which extent these stocks are overvalued, maybe you can listen to that particular piece again, because I do think that we make some interesting points just breaking down the valuation of OpenAI and what needs to happen for it to support this particular valuation which it has, which is $500 billion. Second point, apologies for consistently referring to it as $500 million in that piece. I don't know why I did that. Clearly, I still have to learn the difference between a million and a billion, but there it is. I went away. I have studied. Now I know it's $500 billion. There you go. So I still think that was an insightful contribution if you wish to break down a little bit how these valuations work. Now, I said in that piece that it clearly is a bubble. These are all the signs of a bubble. But sitting back, is it a bubble or is it just simply overvalued? This may be of just merely technical interest. If you're in it and you're losing 40% and that's a downward correction, you're not going to be very happy. But to be honest with you, thinking about this a little bit more, yes, it is a bubble perhaps. But I would believe that it is very highly overvalued at the moment. I do think that if you can stick your money into these kind of investments and hold it there for a longer period of time, up to 20 years or so, we will see a very potent, sustainable upwards value appreciation in these stocks for precisely the reasons that you have just elucidated. Because there is, of course, also the embedded technology in which AI sits and which enables it. It needs electricity. You have said all this, so I'm not going to repeat it. But also, of course, it needs chips, and NVIDIA is one of the drivers of the stock market valuations. So this is kind of the point I wanted to make in this context, which is slightly at a tangent, but still relevant. We talked about gold, we talked about Bitcoin. The equity markets are not a safe haven asset, but they have outperformed despite this geopolitical risk, which people clearly must perceive. We can infer this from the performance of gold and the performance of Bitcoin. And why is that? This is also driven by AI stocks, by tech stocks in general. It is now the case that the leading 7 tech stocks, the so-called Magnificent 7, account for 36% of the market cap of the S&P 500. 10 years ago, they accounted for 20%.
And even then, we thought it was high.
I was just going to say, I was just going to say exactly that.
It's like, oh, that's huge. That's huge. Wow. And here we are.
I was just going to say exactly that. I mean, on the one hand, I would have now said it was only 20%, but at the time we saw that, it was an alarmist call. It was, oh my God, what's going on? The concentration of the market value.
No, it's
terrible. A small amount of stocks is increasing, we said at the time, and now it has nearly doubled this concentration. So this is behind the stock market the stock market depreciation. So if the stock market's correct, this is not our theme now, then they may either be driven by a downward correction in the tech stocks or driven by something else, which the Trump administration might do. We've talked about this in a different context. So they're either driving the stock market downward correction or they are dragged down with it. Whichever way it will go, if you look at the use case of artificial intelligence and of the embedded or embedding technology, then it sort of stands to reason to expect this technology to be transformational in nature. So over a longer term period, I do believe that some of the valuations which we're seeing at the moment will be supported by real world earnings. But you mentioned DeepSeek. You see, that's interesting to me also, because the DeepSeek moment wasn't really a panic moment. It wasn't a reset button. It wasn't a pin that burst a bubble. DeepSeek is a technology which managed to introduce a smaller sort of revolutionary technology. I don't know, we haven't really talked about this, I don't think, and I'm not going to do it now, but the thing which enabled LLMs was a technological component known as a transformer. And DeepSeek managed to develop a transformer which is up to 10 times as efficient as those which are driving the LLMs of the US domiciled companies. But it was open source, so everybody could basically see what they have done and copy it or implement the software engineering know-how articulated there into their own work. And that appears to have happened, because I do remember that also my investment, they went down by 10%. I wasn't very happy with that. But then it all recovered and we are now at a higher level from where we were. So I think long term, there must be a sustainable case for it. But currently, as we said in our piece on OpenAI, I can't see these kind of valuations to be supported by current earnings.
Yeah, I mean, I think obviously I'm looking like way into the future, but I do think that it is possible that these chips could become commoditized. There's a danger because they're so central to everything. There is a huge incentive for companies to try to make them more efficiently and all that kind of thing. And this is generally what tends to happen in this kind of scenario, is that maybe, especially let's say China makes huge breakthroughs in terms of making chips. I mean, who knows? At the moment, it's not so great at the top, right at the top end, but the middle is good. The low end, very good. Middle, getting better. It's only a matter of time before the top end, is breaking out as well. Yeah. So, I mean, I just think that, once that happens, that, commoditized Nvidia, unless Nvidia does something else, then Nvidia's valuations are going to look, like fantasy, and that's still, we got a long time before that happens. But still, what I'm saying is, underlying, it's still going to be the infrastructure that is needed, and if it's not for AI, it's going to be for a whole load of other things.
Yeah.
So, last thing, London market. I mean, both of us, we worked at a company called Cazenove, which was subsequently bought by JP Morgan, which was well known for being a massive hitter. I'm not just saying this because we worked there, but like, it was known to punch way above its weight in terms of IPOs and stuff like that. I mean, we were, you worked on loads, I worked on loads. And although I wasn't able to participate in loads because my client base was Japanese, and there were all sorts of restrictions, but it was very exciting. And I did one of the ones I did was really funny, but I'll save that for another day. But I would say that, we were kind of used to the fact that the London stock market also punched way above its weight in terms of the global, financial market. It was for a very long time, London or New York, London or New York, and but now we are way behind. We raised something like 545 million dollars has
This
been
time it's
raised.
correct. It is
Yes,
million.
yeah, in London this year so far, $545 million. In New York, two exchanges, they've raised $33 billion. We are the 25th. We are the 25th place in capital raising centers around the world. 25th. We are a backwater. That is just unbelievable or
Yeah.
believable. I mean, it's such a huge thing. I'm not just being an old man here ranting. I know that, London has been a major centre for a very, very long time, and we have absolutely lost it. And it's going to be very difficult to climb back up again, because I think that, obviously everyone can trade on past glory, but that doesn't last forever.
Hmm.
And unless big changes are made, we are going to continue to be a backwater. So yeah, what are your reactions to that?
Yes, I echo all of this. As you now heard, guys, we used to be at a shop called Kazanov, and that was one of the last remaining blue-blooded merchant banks in this country. What Kazanov was doing particularly well is to be a corporate financier to the UK companies. I think the Kazanov was a corporate broker to 50% of the FTSE 100,
That's
if
right.
not
Yeah.
more. And because of that, there was a steady flow of corporate actions which Kazanov facilitated, not just IPOs, but mergers and any type of corporate
Fundraising also.
action any of these companies would want to do, a share split or a equity raise, etc. And so Peter and I, we have become used to being at one of the centers of this deal flow. And I remember that almost during my entire working life, there was always this good-natured competition between London and New York. It was either London or it was New York, but it was never anybody else. I mean, Paris,
No.
Frankfurt, these exchanges were not really recognized by anybody in the city. And now we are number 25. We are now rubbish.
Yeah.
Basically.
Yeah.
And we have discussed that also on the show. I must admit that I have not done any analysis into why this happened. However, it is true that to some extent the decline in IPO or in corporate deal flow aligns with Brexit. So I'm not making an ideological comment here. You know by now that I have, of course, a big critic of Brexit, but I'm not using this dynamic in order to get another point of criticism in. I truly believe that one of the reasons why London was punching above its weight was because you could do an IPO, a corporate action here in London, if you are, for example, a US domiciled company with a subsidiary here, you could speak the same language, by which I mean actually speak it as a native speaker, not as a person who learned that at school. You know, you were idiomatic, you spoke the right register, you were chummy with the people here on the dealing floors. There was a divide, but it was a good-natured divide. American English and British English. Yes, they kind of can tend to sound like foreign languages, but that's amusing to a native speaker. So there was indeed. I'm sorry to bring this term, but there was a special relationship between the centers of New York and the centers of London. But in addition to that, and this is the point, any company domiciled in the UK IPO'd on the London Stock Exchange would have a gateway into the single market of Europe. And if you look around the world, then there are three economies in the world which are driving. One is China, as the biggest producer of consumer goods. The second or first, depending on where you look, are the United States. I'm looking at GDP here. And the third one is the single market. So in other words, the single market is a global economic superpower. And any company domiciled in the UK used to have access to this vast market. Now, after Brexit, companies domiciled here have access to a market which is 70 million inhabitants, something like 2.3 trillion pounds in GDP. That's not nothing. That's one of the big 10 in the world. But it is, of course, much less than the 26 trillion which we have in the single market, and much less than a very similar number that you have in the USA. So that's important. And then when it comes to tech, of course, also there's a level of sort of entrepreneurship and innovation which is incubated and actively fostered in the United States. And there we also now have to look at the Trump administration and say that the often reckless but nonetheless beneficial drive for deregulation in the sectors of the economy does benefit the tech sector. And you can look at this in whichever way you want, but by which I mean some aspects of this are clearly negative and unsustainable, etc. But looking at the relative attractiveness of an IPO center, if I had a tech company in the startup, I would probably also go to New York now rather than to London. How this can be changed, I honestly do not know, because if I'm right and the exit from the single market is one of the, if not the biggest driver for this decline, then of course the sector of the London stock market, which is IPO related, will not revive that easily unless we do have, again, some form of access to this market. And that, I think, is just it's just common sense. Of course, if you have access to a 500 million people market or a I'm talking US, 350 million people market versus 70 million, well, obviously that's a bigger market. If it was a single market, you have 500 million for 50 million people who live here. That's a huge market as well. So that, I think, is the issue. And any amount of deregulation which we can do here, any amount of simplification of the listing rules which we can in the London Stock Exchange, which have already been done. They were simplified just 6 months ago, have clearly not changed the tide. And it
is, as they say, like weeing into the wind.
This is a wonderful image. Where would the wee go?
Yes. Sort of backsplash going on, but I mean, I think that's just the thing, right? I mean, I think that we're not. I would agree with you. I think that it's coincided because I think that the UK was seen by many as the gateway to Europe. And we've lost that, and we're not going to get, because Europe is not going to give it back. So
not indeed, not readily, but of course
not willingly. Yeah.
But there can be deals can be done, because let's not forget, Europe is a beneficiary of this, of course, as well. But well, this is now going too far, but we need to then look at the political willingness of the governments and future governments which may come in. And if you have seen the recent polls, then if it would be Reform UK who will gain a let's say visible presence in parliament, if not a majority, then very clearly this party is the legacy party of the Brexit party, and the name of that party suggests, of course, what they want to do. So under such a government, we're not going to come back in. Labour is doing a solid job at the moment, actually, to forge deals with Germany and other parts of the EU, and hopefully with the EU, to rectify some of these issues. But coming back to the London Stock Exchange, unfortunately, I would believe that the IPO pipeline is going to remain sparsely populated, and yeah, I mean, we are out of the markets, but it still pains me to see that my sort of my alma mater, if you like, my professional home for 20 years has kind of lost its luster a little bit there. It's not more than a little bit.
Yeah, no, it's sad. It's sad, and I like you say, they've tried. I mean, I suppose the next thing they could do is to stop stamp duty, on share trading. But even that, I mean, everyone's been going on about that for years, and I do think that I mean that'll help for a bit, but I don't think it's not gonna address the underlying causes which you have outlined. So yeah, it's a real shame. It is a big deal because the financial services industry is a very big part of brings in a lot of GDP. So
I can quantify this, by the way. London accounts for 10% of the UK GDP, and the city of London accounts for 1%. This is huge. No other sector accounts for anything near that much. Fishery, for example, accounts for 0.1% of the UK GDP.
Yeah.
The City of London and the financial services sector is the number one manufactured good in the UK and the number one export good for the UK. And we have willingly left the market, which enabled that particular ingenuity that we have here, because it is the ingenuity to structure deals and engineering and the innovation to do that, which is actually an asset of the London Stock Exchange. But of course, that also is that's IP, that's intellectual property, that's driven by people. And this was domiciled here in the London Stock Exchange, or in the London market in general, because people were attracted to London as the premier financial center. So they came from everywhere. They came from France and from Germany and Italy, etc. Once London is seen relatively less attractive, they might either go to New York or they might stay where they are, because now relatively Frankfurt and Paris, etc., are no longer backwaters.
No.
And so it's going to be an uphill struggle to regain this.
I think so.
Unfortunately,
it's going to need some dramatic, stuff to reverse this. Anyway, going to have to leave it there. But lots of ground covered today. Thank you so much, Ralph. As always, always a pleasure.
It is.
Have a great day. Evening.
I'm going out for dinner, guys.
Brilliant. I'm going to make dinner. Not for you. But for my family.
You never make dinner for me.
No,
you never give me anything. Actually, just saying this. I never said this before, but he doesn't actually pay me anything. You guys know this. You never get anything. I don't even get a rancid burger from that.
No. At the moment, anyway.
Actually, that's not true. That's a lie. You do take me out.
Yes, there we go.
Why don't you take me out again?
I will do.
For dinner.
Don't worry. Yeah. Okay.
Excellent.
All right.
Everybody heard this.
Anyway, all right. Good. Everyone's a witness to this, aren't they?
On here, exactly.
Anyway, the buy dinner for Ralph, society, whatever. Anyway, I'll leave it there. Thank you so much. Thank you everyone for listening, watching. However you're consuming this, and we'll be back again soon.
Thanks for
Many
having me,
thanks.
guys. Thanks for listening. Bye-bye.
Bye.